Record gold buying by central banks. In 2023, central banks purchased 1,136 tons of gold, the largest annual increase since 1967. That is not a routine portfolio adjustment, it is a historic move. When institutions that have the power to print money decide to accumulate large amounts of gold, it tells us something important about how they see the future. These purchases are accelerating at a time of global instability. Geopolitical tensions, inflation shocks, banking stress, and growing uncertainty about the international monetary system. Central banks are not reacting emotionally, they act strategically and long-term. Most importantly, this trend signals a subtle but meaningful shift, declining trust in paper currencies. Gold carries no promise from a government, no counterparty risk, and no political conditions. By increasing gold reserves, central banks are quietly reducing their reliance on currencies that can be inflated, sanctioned, or destabilized. Gold, in a time when paper loses value today, money can be created with a few keystrokes. Governments and central banks can expand the money supply almost instantly. But gold cannot be printed. It must be mined, refined, and physically stored. Its supply grows slowly and predictably. History shows us a clear pattern. Currencies come and go, empires rise and fall, monetary systems change, yet gold has remained a store of value for thousands of years. From ancient civilizations to modern economies, it has consistently survived political and financial upheaval. Because of this history, gold is widely seen as protection against systemic risk, the kind of risk that affects the entire financial system, not just one company or one country. When confidence in institutions weakens, gold often becomes a form of financial insurance. Global crises driving gold demand. Several major crises have reinforced this renewed demand for gold. After the pandemic, inflation surged to levels not seen in 40 years, eroding purchasing power across the globe. For many countries, this was a wake-up call about the long-term consequences of massive monetary expansion. The war in Ukraine introduced another powerful lesson. The global financial system can be used as a geopolitical weapon. Access to the SWIFT payment system can be restricted and foreign reserves can be frozen. This demonstrated that financial assets held in foreign currencies are not always fully under a nation's control. At the same time, major corporate collapses, such as Evergrande in China and Silicon Valley Bank in the United States, showed how quickly confidence can evaporate. When companies fail, stocks and bonds can lose value overnight. Gold, however, does not depend on a company's balance sheet. It remains a tangible asset when financial structures begin to shake. China. Gold as strategic shield. Since 2018, China has increased its official gold reserves by roughly 70%. That is a substantial and deliberate shift in reserve strategy. For the world's second largest economy, such moves are never symbolic. They are strategic. One of the key motivations is reducing dependence on the US dollar. A large share of global trade, including Chinese exports, is still settled in dollars. But relying heavily on another country's currency creates vulnerability. If access to dollar-based systems is restricted, economic flexibility can shrink overnight. Gold, in contrast, is a neutral reserve asset. It does not rely on the policies of any single government. At the same time, internal financial stress, such as the Evergrande crisis and the global example of sanctions on Russia, have reinforced Beijing's caution. By steadily accumulating gold and keeping domestically mined gold at home, China is effectively building what some call a golden wall, a financial buffer designed to strengthen long-term sovereignty and resilience. Russia, gold instead of dollars. Russia's shift toward gold accelerated after the 2014 sanctions following the annexation of Crimea. At that point, Moscow clearly recognized the risks of holding large amounts of reserves in dollars and euros that could potentially be frozen. Since then, Russia has built its gold reserves to more than 2,300 tons. This was not just diversification, it was preparation. Gold became a strategic alternative to foreign currency assets. When Russia was excluded from parts of the SWIFT system in 2022 and significant reserves were frozen, gold remained one of the few assets fully under domestic control. It could be used indirectly to facilitate trade, support the currency, and provide a foundation of stability. For Russia, gold became not just a reserve, but a financial lifeline. India, cultural and financial security. India's relationship with gold is unique. Indian households are estimated to own more than 25,000 tons of gold, more than all the world's central banks combined. Gold plays a central role in weddings, religious festivals, and family wealth preservation. It is not just an investment, it is part of social and cultural identity. At the same time, the Reserve Bank of India has been steadily increasing its official gold reserves. This reflects both tradition and strategy. In a country where trust in tangible assets runs deep, gold strengthens confidence in national reserves. Economically, gold also serves as protection against rupee inflation and reduces reliance on the US dollar in international reserves. For India, gold represents both heritage and hedge, a bridge between culture and financial prudence. Turkey, defense against inflation. Over the past decade, the Turkish lira has lost more than 80% of its value. In 2022, inflation surged to a peak of around 85%. For ordinary citizens, this meant rapid erosion of purchasing power and savings. As confidence in the national currency weakened, people turned to gold as a store of value. Gold buying surged at the household level, reflecting a search for stability. The central bank followed this trend, purchasing 148 tons of gold in 2022, the highest amount globally that year. This move was both defensive and symbolic. By increasing gold reserves, Turkey sought to reinforce monetary credibility and align national reserves with the preferences of its population. In times of extreme inflation, gold becomes more than an asset. It becomes a currency of trust. United States, gold as power symbol. The United States holds the largest official gold reserves in the world, more than 8,000 tons. Most of this gold is believed to be stored at Fort Knox and other secure facilities. Whether or not the public sees it, the scale of these holdings carries enormous symbolic weight. Although the US dollar is no longer formally backed by gold, these reserves still reinforce global confidence. Gold represents continuity, a tangible link to the era when the dollar was directly convertible into gold under the Bretton Woods system. That historical legacy continues to shape perceptions of American financial strength. In many ways, US gold reserves function as a foundation of credibility. They signal that behind the world's dominant reserve currency stands the largest gold stockpile on Earth. It is not an official guarantee, but it is a powerful symbol of monetary authority and long-term stability. Europe, gold and sovereignty. And European nations have lived through currency collapses, hyperinflation, and financial crises. That historical memory shapes their approach to gold today. In 2013, Germany repatriated a significant portion of its gold reserves from the United States and France back to Frankfurt. The move was not driven by panic, but by principle. It was a statement of sovereignty, a reminder that ultimate financial security should be physically under national control. Italy and France also maintain substantial gold reserves. For these countries, gold acts as a financial anchor, a safeguard against future instability within the Eurozone or the global system. In Europe, gold is more than a reserve asset. It is a strategic insurance policy rooted in historical experience. What gold is replacing? Traditionally, central banks held most of their reserves in major currencies such as US dollars, euros, British pounds, or Japanese yen, often invested in government bonds. These assets were considered safe, liquid, and reliable. Today, however, those same currencies face pressure from inflation, rising debt levels, and geopolitical tensions. Government bonds are no longer viewed as risk-free in the way they once were. Political decisions, sanctions, and monetary expansion have introduced new uncertainties. As a result, gold is gradually replacing part of these paper-based reserves. Unlike bonds or foreign currencies, gold is not dependent on any government's promise to pay. It does not carry default risk. For many central banks, it has become the ultimate form of financial security, neutral, tangible, and globally recognized. A world without trust. The freezing of approximately $300 billion of Russian foreign reserves sent a powerful message to the world. Geopolitical conflict can directly impact financial assets. Reserves that were once assumed untouchable suddenly became inaccessible. This marked a turning point. The global financial system is increasingly intertwined with politics. Access to payment systems, reserve currencies, and international markets can be influenced by diplomatic relationships. In such an environment, gold becomes uniquely attractive. It carries no credit risk and no counterparty risk. It is not a promise written on paper, it is a physical asset with intrinsic value. When trust in institutions weakens, gold's appeal strengthens, because in the end, when confidence fades, what remains valuable is what you can actually hold. Conclusion: gold as silent guarantor. Every country accumulating gold has its own motivation. For some, it is protection against sanctions. For others, it is a shield against inflation, financial crisis, or political uncertainty. The reasons differ, but the underlying objective is the same: security. Gold acts as a silent guarantor in a world where the rules of finance and geopolitics can change quickly. It does not make headlines every day. It does not generate interest payments or dividends, but it provides something far more fundamental: stability. It is a form of wealth that exists outside political promises and beyond digital systems. Perhaps the most striking signal of all is this: central banks, the very institutions that have the power to create unlimited amounts of paper money, are choosing to accumulate gold. That decision speaks volumes. It suggests that even at the highest levels of global finance, there is a growing awareness that the future may be more uncertain than the past, and that tangible assets still matter.